In this video, I would like to discuss key features, key characteristics of exchange traded funds known as ETFs. So why are they unique? So exchange traded funds have become popular investment vehicle due to their unique characteristics. And so here are some key characteristics of exchange traded funds or ETFs. Number one is diversification. And in this context, they have a broad exposure. They have a broad exposure. So ETFs often hold a diverse portfolio of assets such as stocks, you have bonds, commodities, providing investors with exposure to a wide range of securities, within a single investment. So they have these broad-based asset classes, inculcated into a typical ETF. You have stocks, mutual funds, commodities, and even bonds. They are all inculcated. They are all kind of components of a typical, broad-based exchange traded funds. Number two is trading flexibility. Trading flexibility, and it is a stock-like kind of investing. They incorporate element of stock trading. So ETFs are traded on stock exchanges like individual stocks, allowing investors to buy and sell shares throughout the trading day, at a stipulated market prices. So they trade like stocks. You can buy and sell exchange traded funds the way you buy and sell individual stocks. They possess a kind of stock-like characteristics. Number three is transparency. And under this particular concept, they have that holding disclosure, So most, ETFs regularly disclose their holdings and performance, allowing investors to see what assets are in the fund and make informed decisions. If you go to a typical ETF site, you will then come to, you come to see displayed there the different classes of securities they have, in their funds. These things are not hidden; they are quite there for investors to be able to see and make decisions based on, the content, the constituents of a typical exchange traded fund. So their holdings are like quite they are exposed to the public and they're not hidden. Anybody can see what a typical ETF has in its portfolio. Number four is cost efficiency, and this has to do with lower fees. So ETFs generally have they generally possess lower expense ratios compared to mutual funds due to their passive management style and lower operating costs. When it comes to fees, they charge lower than a typical mutual fund because of they have lower management fee. They charge lower expense ratios because of their lower operating costs. ETFs particularly they are passively managed. So for that reason, the cost involved, the cost implication is remarkably minimal compared to a mutual fund. Number five is liquidity. And this liquidity has to do with the ease of buying and selling. You can very easily buy, and you can very easily sell, an ETF. So ETFs offers high liquidity because they are traded on exchanges and their market price is typically close to the net asset value of the fund. The net asset value is the value of the stocks that form that make up the ETF. And so that is the price in the exchange will always reflect the level of the net asset value of the ETF. So if the stocks in it are not doing very well, the net asset value will drop. And if the stocks are performing spectacularly well, the net asset value will equally rise. And when the net asset value rises, the stock price, the ETF price, as it is listed in the market, will equally rise as well. Number 6 is tax efficiency. It has to do with capital gains minimization. So ETFs are structured in a way that often result in fewer capital gains distribution compared to mutual funds, which can be beneficial for tax purposes. So when it comes to ETFs, you discover that they have that tax advantage because they inculcate tax minimization strategies. They don't tend to pay much in taxes compared to an individual investor in stocks. Number 7 is flexibility and investment strategies. And this has to incorporate variety of strategies. They incorporate, a variety of strategies. And ETFs, are, they come in various types. Including they have equity, that are stock-based ETFs. You have bonds, you have bond-based ETFs, you have commodity-based ETFs. You equally have sector-specific ETFs. They tend to specialize in a given sector or sectors. And equally have thematic ETFs. They invest based on themes, thematic ETFs, allowing investors to choose funds that match their investment strategies. If you like the equity, if you so much like stocks, you can invest in a stock-based ETF. You want the safety of bonds, you can equally invest in a bond-based ETFs. You like a specific sector, let's say the technology sector, you may decide to buy a technology-based exchange-traded fund. Whatever is your choice, they are available for you to choose, as you so desire. Number 8 is no minimum investment. No minimum investment. So they have that accessibility. Unlike some mutual funds that require minimum investments, ETFs can be purchased in any quantity, allowing investors to buy just a single share if desired. So in this particular case, unlike mutual funds where you have, minimum amount requirement you could be allowed to buy, when it comes to ETF, you can buy any quantity of your choice. They're just like stocks. You can buy any number of units you want to buy. But in a typical mutual fund investment, you don't do that. You just buy based on stipulated amounts, stipulated, prices. But ETF is not like that. Number 9 is dividends, and has to do with income generation. So many ETFs pay dividends from the underlying securities, which can be reinvested or taken as income. And, usually when the stocks that are invested in pay dividends, the dividend is channeled to ETF holders. You buy an ETF and the constituent stocks, pay dividends. The dividend goes to you as the investor. So you have that regular income, or you may even choose to reinvest your dividend as the case may be. Please subscribe to this channel and don't forget to like this video. Give it a thumbs up. It will go a long way in encouraging me to bring contents of this nature to you. Number 10, tracking an index. Tracking an index. ETF tends to they replicate a given benchmark. They have that kind of benchmark replication. So many ETFs aim to replicate the performance of a specific index. It might be the S&P 500. It might be a NASDAQ-based index or benchmark, providing investors with returns that mirror the performance of the index. If you are invested in an S&P 500 index, then your returns will be very, very close to or same as the performance of the overall, top 500 stocks in the New York Stock Exchange. So their performances mirror the performance of the index they benchmark themselves against. The number 11 is intraday pricing. There's real-time pricing when it comes to ETF investing. So ETFs are priced and can be traded throughout the trading day, unlike mutual funds, which are priced only at the end of the trading day. This particular characteristic mirrors that of stocks. Stock prices fluctuate. Same thing is with the ETF. You could buy an ETF at any time of the trading, trading at any time during a typical trading session. But when it comes to mutual fund, you only buy mutual fund at the end of the trading day. That's a stark difference between the mutual funds and a typical ETF. Maybe in another video, I will highlight the key differences between an ETF and a mutual fund. Please drop the comments in the comment section if you want me to bring this particular video to you. The number 12 is innovative structure. You have specialized ETFs. These are ETFs designed to achieve specific investment goals, such as leverage ETFs for magnified exposure or inverse ETFs for profiting from declines in index value. It depends on what you want. You want to leverage performance, there are ETF designed for that. And if you want, to profit from, declines in the index value, you quite have, ETF that will help to profit, in that particular market process. And so these key features are what really distinguishes, ETFs from other asset classes.